Hey, what's up guys? John here. Over 1 year ago on this channel, I said that rents will be falling over the next year. Rents are going to be coming down in a very, very big way. In fact, I wanted a podcast about 6 months ago in September. A podcast had about 340,000 views, went semi-viral, talking about my beliefs on where the rental market's going and big troubles coming for landlords. And at that time, that was a very controversial type of video because a lot of people believed that rents were going to, remain strong. They were only going to grow because people simply can't afford to buy, so they're going to be forced to rent, meaning upward demand on rents. But there's so many curveballs coming to this housing market, and I think these curveballs are going to create immense opportunity for a smart, savvy, and educated buyer that has cash and great credit and a game plan. And that's what I think we're walking into. I think we're walking into a huge wealth transfer from landlords and especially real estate syndicators who are raising money on social media to new investors and educated investors that saw all the trends before everybody else. And in this video, I'm going to walk you through what's going on. So please hit the like button. When you hit the like button, YouTube's going to share this content to educate more people about what's really going on in the housing market. And if you need help fixing your credit, maybe you want to invest in your first multifamily real estate deal, a little 2-unit, 4-unit property, get out of renting, build out some equity, build out some wealth in that property. You need great credit to do it. We'd love to help you at GreatCreditFast.com. That's GreatCreditFast.com. We're getting incredible results for our clients. You can give us a call today at 561-430-5900. Take a look at this. So this is the narrative that we were told. It says currently inflation, right? Everything was about the dollar's in really big trouble. Inflation is going to be a huge issue. So what you want to do is borrow money at 3%, invest it into an inflation hedge like multifamily real estate, and you will be able to weather the storm. But, and here it is right here. This is from the NAR, National Association of Realtors. It says, in a period of high inflation, investors will look for assets that yield positive returns. Currently, multifamily asking rents are up 11% year over year, while single-family apartment rents are up 13% year over year. With strong apartment demand, cap rates are likely to hover around 4.5% from the 2021 Q1 level of 4.4%. At the height of the pandemic in 2020, caps are about 5.25%. Right? We've seen caps go as low as 3%, 3.5%, especially in South Florida, in certain areas of California, in Austin. We've seen really compressed cap rates, meaning that these landlords are really baking in that they see a lot of future rent growth, stabilized borrowing costs, stabilized insurance costs, stabilized vacancies. Everything was going to remain the same, and now these landlords are about to get smacked in a really bad way. Here's what's going on. So the Penn State researchers say that new rents have decreased 3.5% year over year, 3.3% over just the past 2 months. 2 months. A stunning annualized decline of 18.1%. So again, the Penn State researchers say that new rents have declined 3.3% over just the past 2 months, a stunning annualized decline of 18.1%. So what does this mean with the landlord? If you bought a property at, say, a 4 cap, meaning $1 million property making $40,000 a year net operating income, and now rents have fallen 3.3%. That 4 cap is in big trouble, right? And as this is happening, people forget, we were always told this big story about housing shortage, we need more units. Well, a lot of people bought into it. And in 2020, look at the supply of new apartment housing. Total multifamily housing units under construction. It increased right here, 45% more apartment buildings. What changed? So how can you add that type of supply to the housing market and then not see this negatively impact cap rates and rents? Right? You're going to, because there's going to be more competition for the same tenant, meaning prices are going to be coming down. And so as this is all happening, I saw this actually on Twitter today. I thought it was comical because it's true. It says, I want to let you know that things are not going as well with this property due to the reasons. And this is a syndicator. It says, this is part of a mandatory capital call email from one of our investors received another syndicator he invested with, nothing like some floating rate debt and not calculating reassessment of property taxes when you just bought a property. So it says, I want to let you know that things are not going as well with the property due to the reasons which I listed below, right? Mortgage payment increase due to rapid increases in interest rates. Rent collections decreased due to non-paying tenants. Evictions are in progress. Property insurance costs increased 40%. Property taxes increased 20%. We have to buy interest rate caps down the road, right? So this is what's going to happen to these landlords. When you buy commercial property, by the way, you're able to basically walk away from the deal. It's not like a single family property where you buy the property, you use your credit score, you're guaranteeing the loan. The guarantee of the loan is the net operating income, the cash flow of the property. But when the cash flow starts to get crushed, people just walk away. They're not going to just write check after check after check indefinitely of losses. And so as this is playing out, right here it says high mortgage rates weaken home prices for 6 straight months. We're starting to see this. We're already starting to see this. Fannie Mae prepares for possible losses of multifamily loans this year. Wall Street Journal, this says property taxes are going up. Here's how to lower your bill, when to appeal a tax assessment, and how to make your case. The cost of homeownership will rise for millions of Americans in the coming weeks as new property assessments arrive in the mail. This just came out. Like, this is happening right now. Property taxes have risen across much of the country in recent years. In the most recent data, the median tax bill increased more than 8% to $27.95 per homeowner in 2021 compared to 2019. And this is a senior economist at the National Association of Home Builders. Local governments rely on property taxes to help pay for public schools and other services. Municipalities differ in how they calculate taxes, and the frequency of assessments can vary from annually to every few years. But each year, some municipalities send homeowners prospective tax assessments. Some homeowners can see higher bills this year due to factors that range from higher assessed home values to lower local revenues, and the end of some federal stimulus programs. Now, as that's happening, we have this story that's breaking. Economists have said that renting and investing in the stock market is better than investing and owning a house. In 2022, that could be especially true. And this is about properties, right? So apartment rents fall. And they're saying the same exact thing. Rents fell 3.5%. 3.5% is what they're saying. But here's what I think is going to be a really unique spin on the housing market that people aren't taking into consideration. You have a situation where you have retirees that are baking a soft and cush retirement as being what the future looked like. That was set for them. They worked their whole life. They saved up money. They were very responsible. And then they got hit with this big curveball. And what are they going to do, right? The big question is, what are they going to do? Because there's tens of millions of these retirees. Are they going to sell their home and take fiat currency, not knowing how bad inflation and the cost of living is going to get over the next decade? Or are they going to rent out their home? I believe we're going to see a couple things happen. One is you're going to see a lot of these retirees start to rent out their homes. Two is you're going to see the retirees that don't have anywhere else to relocate start to rent out rooms in their homes. On websites such as Roomy, there's tons of these websites out there that will allow people to start renting out their homes. So renting out small little rooms in their houses. We're going to start to see this, but what I think is going to be unique about this, though, is that usually a studio or a bachelor apartment or something like this would be the entry level to getting your own place. You know, maybe you spend $1,000, $1,500, $1,800 to get your own studio or one bedroom, but you might be able to go rent a room somewhere for $800, $700, $900. And what's ultimately going to happen is as more supply starts to open up to the market and people have less discretionary income, people might not be able to say, I want my own one bedroom. Instead, they might have to go to a rent a room situation, right? As there's new inventory, then this also comes to play. Even look, like couch surfing and living in cars, more over 65s retire without owning a home and can't afford rent. And so we start to play this out, looking at how this works for syndicators, for multifamily investors. Because if you are on YouTube, on Instagram, on TikTok, you heard nothing except real estate syndicators talking about how much money they're making and how great it is to invest in multifamily real estate. And some of these guys are extremely smart. Some of these guys are, they have it figured out. They knew everything was coming, but others did not, right? And so when you look at people that are buying 3 caps and 4 caps, what you're going to start to see is all of these investors that invested with them regret that decision over the next couple of years. So here's how this plays out for most value-add syndications, meaning they wanted to buy a deal, maybe a $20 million deal, and they wanted to increase the rents, and then when you increase the rents, you're going to increase the net operating income, and then the net operating income is going to basically be the net profit of the building, which is going to then reflect the new value of the property. So they basically get a huge return on equity if they can increase the rent, which is a great thing for the investors, right? It's even a great thing for the city because as they do that, the property taxes rise to the property, and there's more money to fund, street services, schools, police departments, and governments and everything happening in the city, right? So it's a good thing for the government. But when you take a look at how this thing plays out now, as rates and everything has changed, you're going to start to see that we're going to see a tsunami of foreclosures in commercial real estate. There's no way around this, especially as we hear more and more about the job numbers are great, inflation, it's still stubborn, we need to combat it, we need to increase interest rates, that whole narrative. When you hear that and then you see what's going on here, you'll see what's happening here. So I'm going to walk you through a situation. So I'm going to make this a little bit bigger. Let's put this on, let's say 20%. So let's say that the deal, it's a value add deal, $20 million, right? A $20 million deal. The plan is to increase rents 10% roughly, and spend $25,000 per unit to fix up each unit. Let's just say it's an old 100-unit apartment building. So they're going to spend $2.5 million in actual cost, renovation cost. And they're going to put $6 million down on this $20 million deal. So they're going to finance $14 million. And they're going to do so at 3.5%, right? Short-term loan, 3.5%. The monthly cost is $62,000. Call it $63,000, right? $62,866 a month, right? The targeted monthly rent is currently $1,500. They want to take it to $1,700, right? So they want to make $200 extra per door, which is a great situation for them, right? If they invest $25,000 per unit and they're making $200 a unit per month, right? I mean, they're going to do pretty well. But here's what's interesting here. Of the $200 per month, that income increase on that $20 million deal, it's $20,000 a month. Right? So they unlocked about $4 million in value on that deal. So if they bought it hypothetically for $20 million, they financed $14 million, they put $6 million down, and then they just unlocked $4 million in value. They put $2.5 million of that in, right? So they made $1.5 million in value, $1.5 million in value on a $10 million raise. They made about 15% plus the monthly reoccurring they were hoping to get. Plus they probably make a pretty good spread on a cash out refi, right? So like they would do well. But here's how this situation kind of plays out now, because that 100 units, $1,500 a month, they're hoping to get to $1,700 a month, which would be $170,000 per month in gross scheduled income. This is if it's 100% rented, which it's not. It's never 100% rented. Even 2018, 2019, 2020, you were starting to see 5%. 5% vacancy rate is common. So out of 100 units, you'd have 95 rented. Still good. But what does this look like when you have increased utility costs, when you have increased cost of living, when you have increased food costs, when you have student loans that are still paused? And when that comes back, there's going to be additional cost. You have cost of insurance for your car, cell phone bill. You have all these different curveballs. What I think is going to happen is you're going to start seeing more and more people start to default on paying their landlord. They'd rather pay themselves and feed themselves than pay the landlord. They know the eviction might take 2, 3, 4 months. They'd rather buy that time to figure out a new situation than to pay the landlord. And we're going to start to see that happen. But as that's occurring, property insurance, $200 a unit. So that's $20,000 a month on a $20 million deal. Property taxes, 1.25%. And this is not factoring in for the new assessment. $250,000 a year, $20,000 a month. And new loan costs, when this loan resets from 3.5% to 7%, their monthly cost is going to go to $94,000 a month. And then property management, say 10%, $170,000 a year, so about $14,000 a month. Some people might say, oh no, you can find something better. Okay, say 8%, say 7%. It doesn't change the numbers. If it goes from $14,000 to $10,000, $12,000, it's the same thing. It's the same. I'm not even factoring in here evictions, vacancies, repairs. I'm not factoring in any of those costs. I'm factoring in it being rented 100% of the time. So that's why I'm being extremely conservative here. Their total monthly cost would be $130,000. $130,000. And this is based on $170,000. So they have $40,000 if everything in monthly profit, if everything goes completely right, and they never have an eviction, they never have to repair anything, they don't pay out any type of dividend to their investors. The manager, the syndicator, the general partner, they get nothing, right? It's all right there. So 40K. That is a big problem when you start to actually add in these situations here, right? And this is all based on like a 5% cap rate. When you start to add in all these problems, you're going to start to see a problem for a lot of these landlords. And that's what I'm betting. I'm betting on we're going to see compressed rents. Rents are going to continue to fall. The cost of our money is going to continue to rise. Insurance and property taxes are going to continue to go up. We're going to see more and more people behind on their rent. And we're going to start to see a situation in which it's going to wash out a lot of leveraged landlords. If you are a landlord and you are in a really good situation, then you're going to put yourself in a better situation because you're going to be able to go out there and pick up other deals. If you're renting right now, you could be in a situation where it's a great time to save money. It's a great time to fix your credit. It's a great time to kind of build out a game plan. Because as things start to get a little bit, more real for a lot of these landlords, there's going to be some big opportunities. A lot of small mom and pop landlords too are going to be trading out their properties. You have 20,500,000 multifamily units owned by small mom and pop business owners and landlords. What are they going to do when things start hitting the fan? Borrowing costs are skyrocketing. They're going to have to start to sell off these properties. This is the time. I think some huge opportunities coming. What do you think? Drop it below, hit the like button, subscribe here, and subscribe also on my second channel. It's an interactive call-in show and a podcast. And LinkedIn, Twitter, Instagram, and TikTok up in the banner. If you need help fixing credit, we'd love to help you at GreatCreditFast.com. That's GreatCreditFast.com. Give us a call at 561-430-5900.